Most people treat the stock market like a casino. They see an environment of chaos where success requires guessing exactly what happens next and placing your chips on the right number. But the highest echelons of institutional finance operate in rooms with no windows, no clocks, and no distractions. At this level, traders do not monitor corporate logos or the evening news. They track contracts, abstract numbers tied strictly to mathematical possibilities. The elite players in these rooms win because they build systems around the fact that the future is inherently unpredictable. Instead of trying to simply guess what reality will do, they use precise mathematical tools to engineer it. The foundational tool for this engineering is the derivative. A derivative is a binding agreement about a future event, distinct from a direct investment in a physical asset. An airline uses a derivative to lock in today's fuel price, creating a predictable cost line. While market prices spike and crash, the airline is secure. This risk is then transferred. Speculators buy these contracts to bet on those fluctuations. Risk becomes a tradable product. Buying and selling risk at scale leads to a structural concept called optionality. Look at this risk-reward graph. The downward line, representing potential loss, hits a solid wall just below zero. The downside is strictly capped, while the upward profit line remains open. This math governs the top tiers of wealth. Venture capitalists find one giant success to offset dozens of small failures, and options traders cap their exposure while waiting for a breakout. They all deploy a lose small, win big framework. Wealthy players prioritize structuring asymmetric outcomes so they can survive being wrong until they hit a massive upside. This control over the future translates directly to how Wall Street evaluates companies in the present. The central principle of finance is the discounted cash flow. It suggests a business is worth the present value of all the cash it will generate in the years to come. But watch this chart. When a modeler shifts the growth assumption slider about a fraction of an inch, the total valuation bar on the right triples in size. The entire output relies on the subjective inputs chosen by the person building the model. Intrinsic value is a narrative, interpreted and shaped by whoever controls the assumptions, rather than an objective truth to be discovered. Even perfect models fail when the financial ecosystem shifts. These collapses are rarely driven by the performance of individual companies. The primary drivers of the market are central banks, monetary policy, and interest rates. It is a mechanical domino effect. When interest rates rise, borrowing becomes expensive, corporate investment slow, and asset prices are forced downward. Market crashes occur when buyers disappear and the system locks up. Profitability is a metric for growth, but liquidity is a metric for survival. Companies and individuals fail when they run out of cash to pay their immediate obligations, regardless of their long-term potential. Surviving systemic shocks requires prioritizing cash reserves and flexibility over raw profit. Once you absorb these mechanics, your perspective elevates. You stop looking at the individual pieces and start observing the board itself. Amateurs ask what specific asset they should buy today. Professionals ask how systemic liquidity is shifting and which risks are currently being mispriced. Finance at this level is a game of probability, trade-offs, and continuous adaptation. Real mastery involves building the structural capacity to survive many possible futures, rather than trying to predict a single outcome. The goal of these tools is autonomy. By engineering risk and managing liquidity, you secure control over your time and your choices.